I do like to start off every week talking about what we saw as a kind of a summary for the whole week in the market. I put out, a daily video on most days, but then on Friday I try to kind of summarize what we saw. And so, of course, we have our chart here up to date as of now. Market's doing well.
Yeah,
Yeah,
it was a solid week.
solid week. It's been a solid recovery actually all the way through since basically since the pause, right? After the Liberation Day. It's kind of amazing because, a lot of those tariffs are kind of back on again, maybe not quite the same height, but still higher than we've seen since 1910. I mean, these are pretty high tariffs.
Mhm.
And so, and that's part of what happened this week, right? We had a pretty good jump based on what was just set up with Japan, right? So 15% tariff for incoming, cars for the most part. I think that's their biggest, but from incoming products from Japan, and it was 1.6% prior, so it's a pretty big jump. And supposedly they're going to open their markets more to, our products. However, I don't know, how that's going to go. There has to be a demand there and interest in
Yeah,
those products
yeah.
too.
I think the market's been open to U.S. autos for a very long time, but it's just not very much demand from Japan, just because U.S. cars just are too big a lot of times in Japan.
Yeah, and the market responded positively. You think about that, that's kind of wild. We went from 1.6% tariff to 15% tariff. It really kind of hammers the domestic auto manufacturer because they're paying 25% tariff on a lot of their parts, plus 50% tariff on some of their inputs like
Mhm.
steel, aluminum, and copper. And so Japanese cars could theoretically be cheaper coming in from outside the US than US cars are for people that are buying them in the US, which is exactly the opposite of what, was intended.
Yeah, but I think it's a lot of the market just wanting certainty. You know, with that, at least with that deal, we know what the rates are going to be. We can figure out how it is going to affect earnings for the companies that you need Japanese products, and so there's some sort of certainty that the market's looking for.
Yeah, and the market is a betting mechanism. So the threat was I think it was 25% tariff,
Yeah.
correct? And so, market looks at that as a probability. Okay, what's the probability that we actually end up at a 25% tariff? There's some probability, it's
Mhm.
not zero. And so then all of a sudden you end up at a 15% tariff. Okay, now that's better than 25. All right. So the probability, uh, is now erased and we know what it is. And so that certainty's there. Whether or not it creates all kinds of problems, we'll see what
Yeah.
happens. But the market did respond positively to that. Earnings have been happening this week. I know Tesla had a rough earnings quarter and expected, according to Musk, to have some more, rough earning quarters coming up. And but we saw decent numbers out of Google, which really drove the market that one day.
Mhm.
For all intents and purposes, I think Google was the main piece that helped there. And then AMD came out, and so there's been some good earnings. We've had good earnings for a really long time. Going back to 2020, we've been able to kind of beat expectations by 70+%. That I tell you what, the analysts that are following these companies are just historically underestimating what these companies will earn and what the revenues will be.
We're starting to see some tariff implications.
Mhm.
Some of the car companies have come out and stated how much their tariffs are adding to their cost,
Right.
and so we'll start to see. And also Kroger was another one.
Yeah.
So we're starting to see some sort of tariffs coming into the pricing and cost for
Yeah, that's a good
companies.
example. So GM said, I think, a $1.1 billion loss due to tariffs. Stellantis, is that how you say it? The company that has Chrysler and what have you was a $2 billion loss in the quarter for tariffs. Kroger was, I think, around $1 billion loss from tariffs. Basically, they didn't pass along those increases. Kroger was last week, but they didn't pass along those increases to the consumers, so they took a hit on the bottom line. And yeah, that's exactly what we're seeing is kind of that first little piece. Now, here's the key that's kind of important: as an investor, the stock market still went up, right? Even though those companies were reporting those particular pieces, because they're not big pieces of these indexes, right? If you owned Kroger, I think it dropped 5% or 6% that day on earnings basis. Those types of things. We did see some, crazy thing like Chipotle dropped 13%. I think that's their worst drop in a single day yesterday, or yeah, yesterday. And so there are some pieces that's always out there that's going on. But the mood in the market is definitely positive, right? So you're getting away with some of these other things that are happening. Now, what's the cumulative effect of all of those losses or eventually, because those companies aren't going to lose that much money. There's no way that a car company can lose 2 billion a quarter on,
It's actually 2.7 billion
2.7.
for the half, first
Oh,
half.
for the half,
Yeah.
okay, but still, that's what, 5.4 annualized? That's not gonna happen, and matter of fact, you'll get sued to death by your shareholders, so, eventually they'll push this through, and I do think that's what we're seeing now, is that these deals, maybe they're not the solid deal like you'd really expect, some of those take a long time, but at least the framework of the deal being presented at, say, 15%, 19% on the Philippines, all of those types of things, and the rumored 15% on Europe that we haven't seen yet, but theoretically, they're trying to get there, before August 1st. All of those things are, what's the cumulative effect going to be if companies all absorb those, which, again, they won't for very long. But the problem would be, the stock market eventually takes a beating there just because if every company out there that's taking a hit on these
Mhm.
things, they'd start hiring less, laying people off, restructuring, and then that's the cascade. So you get a company like Google, which theoretically isn't really impacted directly by tariffs, I guess, except for their phones. They're
Yeah,
right.
they don't much of they have some physical products, you have the Nest products and all that kind of stuff,
Yeah, that's right. Nest.
but a lot of their stuff is software and
Right.
ecosystem, right?
Right.
The
Right.
technology ecosystem, so those don't get affected, their ad
No.
revenue won't get affected.
Right. So that, there's these direct impact companies, and they're the ones we're going to see first, right?
Yep.
Which we're seeing now. And we're going to see more of those. And by the fourth quarter, we'll see a lot of those, in my
Mhm.
opinion, just because you won't be able to hold back. And so the auto manufacturers are a great example. So, and then there's these other companies that are insulated from it. And so there's a lot of money going to be going towards those companies. The way that those companies could be impacted is just the overall economy starts to fall apart, then, ads sales drop at Google or whatever, and they've got some good diversifies, but almost nobody makes it through, a recession if we have one unscathed,
Yeah,
unless
there's
it's some really strange company that's designed to do well in a recession, which is not what we're talking about here. Uh, and so that's why. So maybe Apple, I think is only up 5% or something in the last
relatively
couple
flat.
years. Yeah, and that's so it's got a lot of exposure to tariffs, right? Versus say the Googles of the world and maybe Microsoft also probably fit in that same category. So those are the areas that I think are somewhat insulated, at least up front. And then it depends on, what happens and how much impact these things have, right?
Mhm.
On the economy. Because normally if prices are going up, like during the 2022 when prices went up, companies made more money.
Yeah.
They made record money. So they basically used it as cover, right, to increase they were coming out and saying, "Hey, we have to increase the price of our product because there are inputs, our labor's
Mhm.
get costing more." Okay, that's fine. Then you wouldn't have record profits. There's just no way. I mean, right? You would have even profits or less profits because you're seeing this increase. So, and this has been true historically in inflationary time frames. Okay, companies do well and earnings do well, and you'll basically see that snap like we saw in 2023 as those earnings continue to come through. But with tariffs, inflation's coming through, prices are higher, which always means less demand.
Yeah.
Okay, almost every, unless there's elastic demand, which is not very common but is possible. So you're going to see a drop in demand, and these companies aren't making that higher price. They're charging that higher price because of these tariffs. And so this money's just getting sucked out of the economy
Mhm.
worldwide, actually. And so that'll be really interesting to see how that plays out as far as that goes. And so I've got a piece here that I think is interesting, just looking at kind of the inflationary impacts and when they might be coming. All
Mhm.
right. So if you look, all right, so this is I think one of the better leading indicators of price. All right, and this is the ISM Manufacturing Prices Paid Index. And what this is just essentially, are you paying a higher price now versus say last year same time or less?
Mhm.
Right? Yes or no. So we're up to 70% yes, which goes back to the 2022 time frame for when we had that last. And I'm going to show you a chart here as an overlay just to kind of make an. So I'm going to take The orange part of this chart is that same ISM,
Mhm.
reading, and you can see the big jump that's happened in 2025 here at the end. The purple part of the chart is the core PCE inflation index,
Yeah.
right? So that's what the Fed's looking at. Now look at the very beginning back in 2021. It went up way higher than the PCI did, PCE, sorry. And then PCE caught up. So it's a leading indicator.
Mhm.
Now, if you look at it, it can take a while to really jump in there. And then eventually it's also a leading indicator to the downside. See how the orange line started down before the purple line started down?
Yep.
So it's another great indicator of where prices are going to go as far as that goes. And so this is, again, just starting. We're seeing it on the manufacturing side, and eventually, and some of that's getting absorbed by manufacturers. Some of it's getting absorbed by the ultimate reseller like Kroger, those type of things. That eventually stops. Some of the inventory that's still out there gets sold out. Right. I've been saying for a while. It's August, September, October is really kind of when I think all of those things come together, where the inventories dry up,
Mhm.
and then the companies give up on, trying to absorb it themselves. I would think you'd want to absorb it yourself if you thought it was going to be short term,
Yeah.
right?
If you think it's a temporary issue where tariffs will be there for, are just going to be for a couple months and then go back to normal or like much lower, then you just eat the cost.
Yeah, exactly. But I think these trade deals are probably putting a nail in that coffin to a certain degree. When you've made a deal with Japan and at 15%, and the Philippines and UK and China, they got a sort of a deal. I think it expires August 12th, the one that they have now. So they're working on that again. But they've got a framework that they're talking within. So you're starting to see more permanence, at least until things fall apart if they do with these tariffs. And so I think that's what that's going to mean is that these companies are going to start passing this through even faster. I mean, if it's not going to be temporary, then hey, let's move on. So, but this is we'll keep pulling this chart up actually, and to keep looking at this because this is the leading indicator for kind of the inflationary pressures that might happen. Um, but I have something interesting I want to talk about here because I think this is very fascinating. Right now, the Federal Reserve is talking about really staying put
Mhm.
and wanting to see more data and what's the impact to inflation for this um, situation with the tariffs. So normally when you lower interest rates, it ups the demand. And if you lower them too much, it'll up the demand so high that you start to get inflation, right?
Yeah.
Because
You
people
can't
are,
supply enough.
yeah, you can't supply enough. We saw that after the pandemic, just because the supply wasn't there. But this situation, if you have inflation, it isn't possibly because of higher demand. It is simply because the tariff.
There's higher costs.
It's a higher cost. Now that does impact what you're going to do in terms of, you're going to see demand drop in those situations. So, but that's important. So prices go up in essence artificially
Mhm.
without high economic activity. Prices go up because of tariffs. And then all of a sudden, you've got the situation where, the economy starts to slow down because the demand is dropping down because of the price increase. And I think the Federal Reserve, at least from what they've been saying so far, is going to look at this and say, hey, prices are going up. We're not going to lower rates. And they are looking at labor, which is their other,
Yeah.
b- you know, mandate, dual mandate, low, unemployment and low inflation. But labor's a lagging issue. And so that's why they're always late, actually, if they're looking at labor too closely, because labor takes forever for people to get laid off,
Yeah.
even at bad economies. And so I wonder if there isn't some room even now or very soon to start doing some rate cuts on the anticipation that the tariffs are going to slow down the economy and try to get ahead of that a bit, with the idea being that you're probably not going to stimulate inflation even higher if the economy is soft,
Yeah.
even if you are putting in rate cuts. And so I think there is some room for rate cuts personally. And the other thing that I think is interesting is just is the economy and mainly is AI a big enough driver to overcome all this?
Mhm.
Can it overcome, the whole issue with the tariffs, for example, and deportations. And yeah, we have high inflation, but it doesn't matter because productivity is growing so quickly. Company earnings are still flying. And in the end, earnings are the number one key to the market going up, period. I
Yeah.
mean, it's just the way, no matter how it gets there or what we think about it or what we like or don't like, earnings are the key. It's the strongest correlation, of the stock market. So, is it high enough? So, I think back to my experience in the dot-com bubble, 95 to 2000. We had exactly the same conversation. I mean, exactly. The internet is going to be this massive productivity gain, and it was,
Mhm.
right? I mean, definitely right. And look at this. I mean, we're here today. In 95, we wouldn't be doing this.
Yeah, we're streaming across the internet, so
Yeah, and so it's been phenomenal, but the market dropped 45%.
mhm.
Now, this was after this, kind of bubbling effect. I don't feel like we are there yet, but we are, in the overall pattern, it is what you have to watch for. Because there was a comment actually in one of the videos I put out. The AI and the productivity is going to overcome essentially, and I agree long term, but in the short term, the stock market can get so far ahead of itself that you end up with these massive corrections, and just because there's a leverage right now. The one thing that's going up a lot is margin accounts are going up a bunch, and so people are jumping into this. There's a bunch of money to be made in some of these areas. You got some of these, meme stocks are coming back around again. I
Yeah.
guess Krispy Kreme and what was the other one I saw the other day? Anyway, so that type of, craziness is still happening as far as that goes. So there's some frothiness that's happening now, in my opinion, and we'll see how that goes, but nothing like we saw, at the end of the bubble in 2000.
Yeah, but usually when any kind of emerging technology, there's always, like, that hype cycle in the very
Yep,
beginning before anything's kind of I think with this one, we're trying to see where the revenues actually come up from these AI
yep,
companies.
yep.
There's a lot of AI companies out there, but how many will exist and how many will have a successful product with revenue is another
Oh,
issue.
yeah. I mean, so there's all these parallels because if you go back to the early 1920s, yeah, I think in the Detroit area alone, there was like 2,000 car manufacturers. And so there's, three ended up surviving. If you look at the dot-com thing, same thing, thousands of dot-coms and Amazon and, these companies that came out of that, right? I mean, and so the same thing will happen with AI. There'll be all these different companies who will come out of it, who won't come out of it, that type of thing. Uh, but that's the same thing we had. So in 2000 run up in that 5 year period, we didn't have this type of technology. It was just something that was there. The internet was, we were on dial up with AOL. Even at that time, it was pretty clunky. I mean, compared to where we are now. And so again, it just kind of got to a pricing point where it could see today back then, and it started to do, and it just wasn't there. So the reality starts to kick in. And so that's the same thing that's going to happen with AI here. It won't be enough revenue to be generated out of that, even on productivity basis, to support the crazy levels that the prices could get to, right? And so that's where you kind of have that take back component. But eventually, the market's probably right, and the pundits and the future, looks very good with this particular technology, and things do play out. But it's just a human nature thing, this kind of tulip mania that happens, that comes along on a regular basis. So I think it's a very fascinating market. The cross currents that are going on. I mean, it was fascinating before the whole tariff and deportations and all the different things that are happening as far as that goes, and it is even more dynamic now. And so I think that's the battle that's gonna play out here, especially for the second half, maybe for the next 12 months
Hmm.
altogether. Um, you know, is it big enough? Is AI big enough to make up the differential? Uh, you know, and I do remember some stories from 2000. I remember there was a guy on the radio once because Google was came out and went public. It went very hot, right?
Hmm.
And they were the new search engine. I don't know if you guys, I'm dating myself, but we all used Yahoo prior to Google. And
Netscape, Yahoo.
yeah, I escaped out. There's one that had a black lab. I can't remember what the name of that was. Anyway, And Google comes along, they have a better algorithm, basically is what it came. You got more the right more answers more often. They didn't have any revenue, period. And I remember this guy on the radio says, I will eat my hat if they get to $500, which was probably, 25 splits ago. And so it's obviously a good investment. Same thing's going to happen with AI, oh, where's the revenue generation coming from? And I will say these companies in the end, they're pretty good at figuring out where that is. And because Facebook didn't have any revenue generation, now it obviously does, right?
Mhm.
And so there's always ways to do that. So anyway, I do think that's going to be a part of this, but that's more that next phase that would come along, where these companies are, like Amazon and Google and what have you in size and in structure. I will say that this, productivity gain seems so severe on the AI side, that there could be an employment issue that comes along with it. That wasn't talked about as much in the 2000 dot-com bubble. Like, oh, computers are going to replace people. They did. I remember we had two people here just to rebalance our portfolios. It would take 2 weeks solid for two people working basically manually back then to rebalance all of our accounts. And now you have software you can do one person can do it in an hour, hour and a half, and so, obviously, I don't need 2 people anymore. I can
Yeah.
use one portion of one person. So and we survived that, but the AI, jump seems bigger in terms of productivity gain.
Yeah, it's gonna be it can do a lot more and it's more
Right.
advanced. So we'll see.
Yeah, and what I'm reading is about, how fast it might come at us, faster than people are expecting, and so I think that'll be interesting to see how that plays out in the labor market, because we're already hearing rumors, at least, of some of these tech layoffs, like with Microsoft, laying off, and they're calling them an AI layoff, whether they are or not, I don't know enough about it, but it's something that's circulating out there as far as that goes, so that's another dynamic that, could play out over this next 12 months. And I'm starting to broaden my horizons past the end of the year because I think a lot of these things are going to take some time to really have impact. We could have a great stock market before there's any real impact from a lot of these different areas.
Mhm.
For quite a while here. And, right now, I think the setup is good for a decent market going forward. I just don't know how much longer.
Mhm.
Is that a month? Is that 7 months? 10 months? When does the impact of these tariffs start to eat into these things, if at all? And are these other areas strong enough to carry the day?
Mhm.
Right. So anyway, that's what's happening, so far, it's a really fascinating time frame to be talking about what's happening in the market. Great time to be learning, different things, in my opinion. And so again, there won't be another summary for, 2, 3 weeks. 3 weeks from now, we'll have another summary. But, hang in there. We'll see what happens as far as that goes. Again, generally speaking, the summer starts to get soft. It should have happened already on a
Yeah.
seasonal basis. Usually the peak is the 17th of July. And here we are on what, the 25th, still rolling. Yeah.
Mhm.
So different year. Definitely, everybody's talking about August 1st. When everybody's talking about something, it almost never has a big impact on the stock
Mhm.
market. It's never those things that really scare the market. So, we'll see what happens. But anyway, thank you for listening to this summary this week, and we'll look forward to talking to you again in about 3 weeks.